Welcome everybody. We will continue with the treatment of goodwill on admission, but we will now take, in this case, we'll take if the goodwill is not brought in by the new partner. So when goodwill is not brought in by the new partner, the journal entry differs, and in that case, the new partner's current account is debited and the sacrificing partner's capital account is credited. So always remember this, that whenever the new partner is not bringing goodwill, his current account will be debited and the capital account of the sacrificing partners will be credited. We will understand that taking two examples and seeing how it is being done. Now we are going with part 2, where goodwill is not brought in by the new partner. Let us see two cases and after that we will solve that. X, Y and Z are partners with a profit sharing ratio of 5:3:2. They take A as a new partner who comes in for 1/6 share. Now whenever this information is given that the new partner is coming for 1/6 share, you don't have to calculate the sacrificing ratio, because the sacrificing ratio will be equal to the old profit sharing ratio, and here you can see it is 5:3:2. And you can see the information is given that A has brought in 80,000 as capital but is unable to bring his share of goodwill, and the goodwill of the firm is valued at 1,20,000. So if the goodwill of the firm is valued at 1,20,000, the goodwill which should have been brought in by A is 1/6 of 1,20,000, which is 20,000, and we'll do the treatment when we do the sum. Now let us move on to the second case, where you can see there are four partners A, B, C and D, and their profit sharing ratio is 8:7:5:5. E comes in and the new profit sharing ratio becomes 6:5:4:3:2. E brings in 1 lakh as capital but cannot bring goodwill. Now over here the capital has been brought in by the new partner 1 lakh and he is not able to bring the goodwill. The goodwill of the firm is calculated at 3 years purchase of the correct average profit of the last 5 years. Now whenever this statement correct average profit is given, we should find out the correct average profit by making an adjustment table. Now you can see the last 5 years profits are given to you. 2014 the profit was 1 lakh, 2015 there was a loss of 20,000, 2016 there was a profit of 20,000, 2017 there was a profit of 45,000, and 2018 there was a profit of 60,000. Therefore there is a loss in 1 year and there are profits in the 4 years. Manager's salary of 20,000 was omitted every year. It is an expense and it should be deducted from every year's profit and loss account. Our machinery was purchased on the last day of 2015 and was passed through the profit and loss account. That is the reason why the profit has actually converted into a loss in 2015. You can see that. And a depreciation was 10% charged. Okay, so if a depreciation of 10% is charged, it is to be assumed the depreciation will be charged at the rate of the same percentage, 10% on the original cost, okay, of the machine, okay, the value of which is 1 lakh, okay. And you can see very carefully over here that we will charge the depreciation every year at the rate of 10%, okay, but we will not charge the depreciation in 2015. Why? Because it was purchased in the last day of 2015. Now let us take the first case. In the first case you can see that there are three partners X, Y and Z, and they have a profit sharing ratio of 5:3:2. They have taken a new partner A who is coming for 1/6 share. The moment this is said that he is coming for 1/6 share, we don't have to calculate the sacrificing ratio, because the sacrificing ratio will be equal to the old profit sharing ratio, which is 5:3:2. He is able to bring a capital of 80,000. A has brought in a capital of 80,000 but is unable to bring his share of goodwill, and you can see very carefully the goodwill of the firm is given as 1,20,000. So we'll get started with this sum and see how it will be done, and we'll pass the journal entries for the treatment. Now first and foremost we'll have to understand that over here the sacrificing ratio will be equal to the old profit sharing ratio, because the new partner has come in for a specific share, that is 1/6. And therefore the sacrificing ratio will be 5:3:2. Now the second thing we have to calculate is what is A's goodwill. What is A's goodwill? So we are calculating that goodwill of the firm is 1,20,000 and A has come in for 1/6 share. So A's goodwill is 20,000. So A is supposed to bring 20,000 of the goodwill which A has not brought in, and this goodwill will be given in the sacrificing ratio to the old partners over here, as all the old partners are sacrificing, and therefore the first partner will get 10,000, second partner will get 6,000, and the last partner will get 4,000. Now with these two informations, now let us start with the journal entries. The first journal entry will be for the money brought in by the partner A, and the money brought in by A is 80,000. So the first journal entry is bank account debit to A's capital account, and the amount over here is 80,000, 80,000. And the narration is very simple, being capital brought in by the new partner. That is the narration. Now the goodwill has not been brought in by the new partner, and I have already explained to you, when the goodwill is not brought in by the new partner's current account will be debited, and therefore the journal entry will be A's current account debit to X's capital account to Y's capital account to Z's capital account. So what is the amount? See very carefully. 20,000, 10,000, 6,000 and 4,000. Okay, now over here A's current account is debited because the goodwill is not being brought in by the new partner, and the capital account of the sacrificing partners are credited in their sacrificing ratio 5:3:2, and the narration for this entry would be, being the goodwill not brought in by the new partner adjusted in the current account and capital account of the sacrificing partners. Please understand one thing very carefully. This current account has been posted in the debit side, and it will be posted in the asset side of the balance sheet of the new firm. Now let us start with the next case, and in this case we can see there are four partners, A, B, C and D, and they have a profit sharing ratio of 8:7:5:5. They take E as a new partner, and the new profit sharing ratio becomes 6:5:4:3:2. And it has also been said that the new partner E has brought in capital but has not been able to bring goodwill, which is valued at 3 years of purchase of the average adjusted profit, which we'll do later. But first, whenever we are given in a question the old ratio and the new ratio, it becomes very important that we calculate sacrificing ratio and then only go ahead with the sum. So first we'll calculate the sacrificing ratio and then we'll move on to the next part. So first and foremost, sacrificing ratio, the formula of sacrificing ratio is old ratio minus new ratio. Now you can see A as a partner, old ratio was 8/25 and the new ratio is 6/, you can see over there the amount which you are getting over here, 6/20. Okay, I hope it's very clear. 6 plus 5, 11, 11 plus 4 is coming to 15, 15 plus 3 is 18, plus 2 is 20. So we have over here 8/25 and 6/20, the LCM of which obviously will become 100. And now if we divide 100 and 25, we get a 4. 4 into 8 gives you 32, and we have 100 divided by 20 gives a 5. 5 into 6 gives us 30. So over here 2/100 for the first partner A. B, we have over here 7/25 minus 5/20. Now see very carefully, 100 over here, 428 and 25 over here, so getting 3/100. And now we have C. We see very carefully, 5/25 minus 4/20. So the LCM is 100 obviously. 25 divided by 100 gives you 4, and 4 into 5 gives you 20, and over here 100 divided by 20 gives you 5. 5 into 4 is 20. So here it is 0/100, and the last partner we have D, and D's whole share was 5/25 minus 3/20. So over here we have 100. So here we have 20, and if you can see very carefully, 100 divided by 20 gives you 5. 5 into 3 gives you 15, and therefore 5/100. Please see very carefully over here, even though there were four partners A, B, C and D, only A, B and D has actually sacrificed, and the sacrificing ratio among A, B and D is 2 is to 3 is to 5. So this is the sacrificing ratio which we have just now calculated. A, B and D. See very carefully, C has not sacrificed anything, neither has C gained anything. After calculating the sacrificing ratio, which we have got 2 is to 3 is to 5, let us move on to the next part of the question, where we have to calculate the goodwill of the firm, and it has been mentioned that the goodwill of the firm has been valued at 3 years purchase of the average adjusted profit of last 5 years. And you can see the last 5 years profits and losses have been mentioned to you. The years are 2014, 2015, 2016, 17 and 18, and the profits and losses are mentioned over here. First year there was a profit of 1 lakh, second year there was a loss of 20,000, next year there was a profit of 20,000, the fourth year there was a profit of 45,000, last year there is a profit of 60,000. The first piece of information which has been given is that a manager's salary of 20,000 has been omitted every year. So that is a piece of expenses and that has to be deducted from each and every year. So we are doing that, less manager's salary, 20,000 needs to be deducted from every year. The next piece of information which has been given to us is that in 2018 a machinery worth 1 lakh was purchased and it was by mistake posted in the profit and loss account. Therefore, that affected the profit and the profit actually turned into a loss of 20,000. So we have to add the machinery purchase. So add machinery 1 lakh. And since this machine was purchased in the last day of the year, no depreciation will be charged in 2015, but in the successive 3 years, depreciation will be charged at 10%, which has been mentioned very clearly. So less depreciation for the next 3 years, 2016, 2017 and 2018. So we can see over here 10,000, 10,000 and 10,000. These three informations are given to us. First information is the manager's salary has been omitted every year. We have deducted that. Second information has been given, the machinery has been purchased in 2015. Last day, that is 31st of March in 2015. And therefore, you can see over here, we have actually added machinery over here, but we have not taken any depreciation in this year because it has been purchased in the last day. And we have taken depreciation in the all other 3 years. You can see 10,000, 10,000 and 10,000 over there. Be very careful about that. Okay, now let us move on to the adjusted profit. We'll now find out the adjusted profit and then we'll find out 3 years of purchase. So first and foremost, you can see the corrected profit over here comes to 80,000. The corrected profit over here, you can see there is a loss of 20,000 again. These are the losses. So we are putting in a bracket. Okay, so these are to be deducted. Whenever the item is to be deducted, it is advisable to show it in the bracket. Okay, so we can see over here 20,000, 20,000 and 1 lakh. So there is a profit of 60,000 this year, and you can see there is a loss of 10,000 this year. You can see very carefully there is actually a profit of only 15,000, and here there is a profit of 30,000. So last 5 years we are getting 80,000 plus 60,000, 1,40,000. 1,40,000 minus 10,000 is 1,30,000. 1,30,000 plus 15,000 is 1,45,000. 1,45 plus 30 gives you 1,75,000. That is 1,75,000 for 5 years. So divide this by 5. Multiplied by 3, this will be the goodwill of the firm. Repeat again, this will be the goodwill of the firm. 1,75,000 is the total of this, divided by 5, because it is being said that it is basically average adjusted profit. So whenever you're talking about average, we are deducting by the number of years. Over here there are 5 years, you can see, and so 1,75,000 divided by 5 multiplied by 3. If you are cancelling this, you can see very carefully over here how much we are getting. We're getting a 35,000. 35,000 into 3 gives us 1,05,000. Now this is the goodwill of the firm. 1,05,000 is the goodwill of the firm. So what will be the goodwill of the new partner E? The goodwill of the new partner E will be 1,05,000 into 2 by 20. Please see very carefully over there. The ratio is 6:5:4:3:2, and last partner share is 2 by 20. That means we are talking about 1/10 share. So 10,500 is the goodwill which should have been brought in by E, but E is not in a position to bring that share of goodwill, though he has brought in the capital. Now we'll take this 10,500 and distribute in the ratio of 2:3:5 and pass two journal entries. First journal entry to show the capital brought in, the second journal entry to show the treatment of goodwill not brought in by the partner. After we have calculated the goodwill of E as 10,500 and we know that E is not bringing in the goodwill, but the goodwill has to be distributed among the sacrificing partners. In this case, the sacrificing partners are A, B and D, and the ratio of sacrificing is given to you 2:3:5. So we'll first distribute that 10,500, the ratio of 2:3:5, and then we'll pass two journal entries. The first one for bringing in the capital, the second one for not bringing in the goodwill. So let us first distribute the goodwill of the new partner E in the ratio of 2:3:5. So if you divide 10,500 by 10, you get 1050. 1050 into 2 gives you 2,100. 1050 into 3 gives you 3,150. And 1050 into 5 gives you 5,250. So this is how the goodwill should be distributed among the sacrificing partners. Please see very carefully. C has not sacrificed anything, and therefore this will be for A, this will be for B, and this will be for D. Now, another piece of information which has been given to us is that the new partner is bringing in 1 lakh as the capital, but is not in a position to bring goodwill. So we'll pass on the journal entries for both. First journal entry for the capital brought in, and the journal entry is bank account debit to E's capital account. You can see over here the capital brought in is 1 lakh, 1 lakh. And the next one is the goodwill not brought in by E. Therefore, it will be E's current account debit to A's capital account to B's capital account to D's capital account. Okay, please see very carefully. C has not sacrificed, therefore C's name is not there. And the figure of goodwill which E was supposed to bring in is 10,500. A will get a benefit of 2,100. B will get a benefit of 3,150, and the last partner D will get 5,250. So this is how the treatment of goodwill will be done when the goodwill is not brought in by the partner. Please see this very carefully. We had talked about the adjusted profit, average of adjusted profit, and whenever there is an adjusted profit, it is always advisable that you make an adjustment table and find out the correct profit, which we have done. And after finding out the correct profit by the following adjustments which were given in the question, we got the goodwill of the firm and then took out the goodwill of the new partner, which was obviously given as 2 by 20, which means 1/10. Okay, and we got the goodwill as 10,500, and then we have passed in the two journal entries because the capital was brought in and the goodwill was not brought in. So in this lecture, we have done with the concept of goodwill not brought in by the partner. In my next video, I'll stay with the same treatment of goodwill on admission, but here we will talk about when the goodwill is partly brought in by the new partner. That means some part of the goodwill will be brought in, some part of the goodwill will not be brought in by the new partner. So keep watching my video, don't miss any of my channel, and if you have not yet subscribed my channel, please subscribe it and press the bell icon to get the